Okay, I believe we are live Monday morning, 11 a.m., coming off Thanksgiving week. Hope everybody had a happy Thanksgiving, food and family, you too, George, and our viewers. The stock market has gone up for 4 straight weeks. So, you know how we called out the stock market went down for 3 months in a row? Well, off of that, it rebounded pretty quickly. We had a extended weekend a bit with a shortened market on Friday. So, George, if you want to update the people who maybe aren't uh, getting your newsletter, and maybe you could tell them actually how to get your newsletter on your stance and what you're seeing today.
Yeah, well, you can just go to Prospero.ai to get the newsletter. And yeah, I actually just saw I was checking the hot off the press numbers, and I just saw that QQQ net option sentiment went below our bull line. Well, we advanced our bull line upwards. Um, but yeah, I just saw that it went below 40 for the first time in a while. I clocked it at 38. Uh, so obviously that's a very interesting development, and we should watch out for, I'd say, especially a reversal on tech from, I think what we've seen a lot of the year, which is that we see these rallies, we see maybe like a lot of retail, especially on the tail end of the rally, start to pump things out to unrealistic levels in terms of how institutions might want to value things. And then it flips around the other way. We've seen that happen with QQQ and SPY net option sentiment converging before. So yeah, we might be switching more bearish today because that's the kind of behavior that we do end up seeing hurt the market. And I actually just saw a bunch of people come just now, but just to review, um, yeah, QQQ and SPY net option sentiment are converging towards the same number again. QQQ option sentiment has slipped below 40. Which it's been above for I think close to a month. So yeah, that's concerning. I'll definitely be looking to adjust my portfolio today, and anyone that's kind of like unhedged or hedged a little bit, I would look at increasing that. Might be shaping up for a bad week based on this behavior that we've seen so far today.
hmm Yeah, and staying on the topic of like the QQQ and SPY net option sentiment numbers. So in your newsletter, you were talking about, or you were showing that they were both kind of declining into the bull line. And I was wondering if you think about, or it changes the scenario at all on bullish or bearish, if they're declining into the bull line versus increasing into the bull line, and how that changes things.
Oh yeah, absolutely. And I think it's like just as an easy way to look at how I look at things. I would prefer a number of 39 that's increasing from 30 last week versus a number of 41 that's decreasing from 49 last week. Um, I think the direction, like in any number, is super, super important. Um, and that line is there to really give uh, an idea of what I think would kind of flip my view. So something ascending to 39 means, okay, it's about to flip into a bull run. And you might have a lot more on the upswing. And this is kind of the reverse of that scenario, where you go below the bull line and you're saying, okay, a bear run might be coming because of the levels that it was at and the stability that it was at those levels before. Um, so yeah, I think this is definitely some pretty bearish behavior and what I was looking out for to start the week, especially QQQ um, net option sentiment declining um, as a potential warning sign, and I'll be moving things around in my portfolio today for sure.
Now, maybe one reason we're seeing this change in the net option sentiment is I forget the day the Fed report or had their meeting, but it was a few weeks ago, and right after that, the odds of a rate increase went basically to zero, and we've seen them kind of tick up, and now they're up as high as 12%. So, do you think that's one of the biggest factors we're seeing right now as to why the market would get a little bit more fearful?
Yeah, I think sometimes it's hard to know what might be like the leading indicator versus the trailing indicator. Or it's just, sometimes it's just co-signaling and it's hard to really like separate one way or the other. Um, but what I would say is that, yeah, I think the market was, for whatever reason, um, behaving in a way that said that, they thought inflation was tamed. There were definitely going to be no more rate hikes. And I think what ends up happening in these situations a lot of the time is you'll see that, essentially people are getting whispers from people like contacts at different feds. And, sometimes it's like actual, like, inside information. Sometimes it's just people in the know speculating or you inferring what they have or what they're going to push for at the next meeting, etc. So I think that, like, when you start to see, so much turn around from, pretty much 100% bets on zero rate hikes to this moment without a lot of, kind of official word, Occam's razor says there's unofficial word slipping there, or perhaps some things that are coming in that are saying, okay, maybe inflation's not as tamed as people might think. And part of that, I think, is what we're going to talk about later, like kind of the robust holiday spending that we've seen. I think is kind of maybe concerning people that maybe inflation, maybe we're due to get more because of or higher numbers because demand isn't decreasing to the extent that people thought it would.
Yeah, so we have some Black Friday stories and coverage that we're gonna do, but before we get into that specifically, um, I thought this was a really interesting thing that you brought up in your newsletter, where the overall delinquency rate that we're seeing right now is about 4%, which is fairly high from where it's been in the past couple of years for American consumers. But when you take American Express individually, and actually that 4% number was amongst the five biggest uh, credit lenders. But if you take American Express individually, which is has a higher end customer base, it's only at 1.3%. So it's a massive difference from the overall to just them. And you were kind of saying it's a economy of have and have nots. Do you think that'll continue? Do you think those numbers will converge with each other? How do you think that'll play out?
Yeah, I mean, I definitely think that's like, I mean, that number says everything about the haves and have-nots because American Express definitely has a kind of like a higher income clientele than the other credit card companies. And I would even go farther to say that, like delinquencies are at 40%, but charge-offs I think went all the way up to 5% in that same graph that I think you're quoting that I pulled from the Wall Street Journal. Um, and I think that we're seeing a very interesting situation that we've kind of called out for a long time, where like people can be bullish on tech and also bearish on consumer spending at the same time, as weird as that might seem on an economic level. Um, you know, a lot of these kind of like efficiencies, cloud revenues, chips, all of that stuff like will go around to kind of, people that work at those companies, but those tend to be higher income brackets and the quantity of those jobs are not as high. And I would say, especially like when you look at some of the job numbers, sometimes it's looking at job openings, and a lot of these job openings with kind of higher talent, especially on like the coding side, um, they could just be openings and not getting filled. And that's kind of one of the ways that jobs get looked at. But yeah, I absolutely think that we could be facing, as Powell kind of says, some pain uh for everyday people, and we're already seeing it. These levels are unsustainable. Charge-offs are rising, delinquencies, but the question is, why would we be seeing this and the market generally not caring, saying they're bullish? I think just for the exact reasons that we're talking about, that people think we can sustain these company valuations uh, even if consumer spending is down. I do think there's other questions that you have in terms of like some of the specific job openings, so I'll let you direct it from there. But there are a lot of different points that I think we want to touch on tangential to that.
Yeah, so first of all, I wanted to ask you about the disparity between consumers and like the upper economy and lower economy has already been a problem. So is AI making that problem worse? And if so, does it need to be addressed by like people in the business world in the government because it's already a big problem? So if AI is making it worse, it seems like it's going to be just become like unbearable or unsustainable.
Oh, absolutely. I would argue that it is already pretty unsustainable, and moderately unbearable to a large segment of society. I think that's why everybody tends to be so angry, and are pointing that anger in a lot of different directions. But yeah, I mean, I think there's a side to it that I always like to say during this topic, which is this, like, since the industrial revolution, we've essentially seen that, everybody's like, oh, these are going to eliminate the jobs, yet new jobs get created out of that. Now, I do think, as I was alluding to, there are some structural problems in terms of skill sets that I'm not sure people are acquiring to the level that they can get into those new jobs. That's a concern that I have. But overall, I was recently interviewed about emotional intelligence in AI, and I think that one of the things that I've often talked about is, like, if we orient around production and GDP, then machines are going to take jobs, replace people on a huge level because they're just better at production. What they aren't better at, or what they don't solve, are kind of some of these structural problems where the more they take over, if we're not creating new jobs or creating new ways to basically have society work with less jobs and not have a lot of, like, really unhappy and mistreated people. We've got to figure out other ways to either increase trainings, engineer more of these kind of new jobs, and say, okay, if you're cutting these kinds of jobs, big tech or AI, like, make more, say, like, customer service jobs that you're willing to also pay for training for. Like, we definitely need those kind of solutions, or it will become a bigger and bigger problem, because we're basically seeing that in how the market is priced right now. People are saying that, like, there's no real good reason that we're not going to see some decrease in consumer spending eventually from all these charge-offs, delinquencies. There's just no way we're not going to see that. But the market is basically saying that they don't care. They expect more money to be created by technology than that will make up for this lack of spending. So the market is already saying that this problem is going to get worse in the way that it's behaving.
Yeah, and as this is all happening, you have companies like TikTok, which is obviously a Chinese company, but they operate in the USA and they hire and provide jobs for USA citizens. Citibank and a lot of financial companies and like Square, all laying off people, cutting jobs, saving money. This whole market environment is all about these companies uh, lowering their budgets and saving as much money as possible. And it seems like the job cuts are kind of going under the radar and nobody's worried about it right now. But as they're happening, you have, this high credit levels, you have all these, I don't know, competing things in the economy going on. So what do you like, how do you make a clear picture out of everything? Or is it just needs time to play out to be able to see what's going to happen?
Yeah, it's challenging. And I think, especially when you see those job cuts, one of the things that I've always observed is that, absolutely, when I would say, kind of ad based, places like TikTok, or, anything that's, any of the big, communications tech companies, Instagram, Facebook or Meta or whatever, all of them, and Amazon is increasingly generating ad revenues, actually. But I think they're doing it in actually some pretty cool ways. Um, like, they have this new streaming service called Freevee that you have to watch ads on, and I've watched a couple shows on that, and they do this very smart thing where they're serving you ads for products that you can just QR code. Um, I think that that's pretty clever. But yes, I think one of the things that we see is kind of just like, when you see companies like that cutting jobs, that concerns me that they're actually expecting revenue losses. And yeah, obviously, when people are spending less money, um, there's going to be less demand for ads, and obviously, that's going to affect businesses like TikTok. So that is a concerning marker. And to answer your other question, I think it's very hard to read a lot of the signals together. And that's one of the reasons why we set up Prospero the way that we did, especially being able to look at, like, something like a QQQ net option sentiment level. That's a lot more clarity than kind of like coalescing all those factors. Now, as we always talk about, you're only seeing part of the picture if you're just looking at the number and not understanding the surrounding facts in which you can also situate that number. So it's both things. It's a streamlined number that can help you take a lot of shortcuts. But the other thing that we also always teach is kind of like, there are no pure shortcuts. You're going to be cutting some corners anywhere, but we kind of recommend some smart corners to cut if you must by simplifying some of these numbers. Um, that all being said, uh, I think that you do really have to keep a close watch on something like an index option sentiment because we've seen it go to like very bullish levels and then kind of turn back in the other direction. So I think that this stuff is very important to monitor. And at the same time, the other side of it is it's very hard to make sense of it. And if you are doing a lot of trading, or even investing in a smaller portfolio, even if it's like a higher convictions, five stocks, it's always good to have some hedge on. I always have some kind of other direction hedge, um, because I think that that's just like the best way to manage risk and make sure that you're even understanding the downside. And I'll give you a really good example of an interaction I had online because I joined I joined some stock groups just to like learn about how people's research works and also occasionally give tips. And there's this one guy that was asking about like hedging a black swan event. And for those that don't know what a black swan event, it's basically an unpredictable event. So I kind of was like, well, that doesn't really work. You can't hedge a black swan event. They're unpredictable. And it actually, the conversation evolved to being like, yeah, I'm losing a lot of money on this like SPY hedge every week. Um, and that's a really good example of like, yeah, if you're concerned about an imminent collapse and you're overpaying for like a short term option every week, that is really going to eat in your profits, especially in a volatile market. But like the thing that I'm saying that is highly relevant is if you're smart and have a view, like I think you could do very well with um, hedging a more limited and intelligent level of circumstances, which is just like, okay, you can't boil the ocean, you can't hedge against any catastrophe. And like my advice to that person ultimately or anyone is just like, you should just buy the S&P 500. If you're that worried about catastrophe striking your portfolio, paying for hedges that you want to like protect against everything, well, that's why you buy an index in the first place. Thing one. Thing two is like, okay, you're going to research the process. You're going to understand your macro review. You're going to understand all of that. Okay, what's your thesis? What are you actually wanting to hedge against? Because if you're wanting to hedge against, China attacking Taiwan, I might say, okay, short Taiwan semi and go long, the ETF index, right? Or sorry, the ETF semiconductor index, because basically you're exposing yourself. You're basically going to profit if like off of specific risk to Taiwan semi versus like the industry as a whole. And that way, if the industry as a whole goes up, like Taiwan semi is probably going to go up too, but some of that risk is actually going to be always kind of baked into its price. So it might do better the index, it might not. But that's a really good example of taking like an intelligent hedge against a view that you have, or if you're just worried about general war, right? You can buy General Dynamics or Northrop Grumman, right? You can buy the defense contractors, and that's a great hedge. I'm advising people like lithium, I think is a great thing. If you're worried about US China tensions generally and not necessarily Taiwan, like the price of lithium, I think is going to become that much more kind of some of these other rare earth metals are going to become, I think, that worth that much more, especially in America. They'll be gouging if there's any situations like that. So I think it's just if you want to be an advanced enough trader that you want to think about hedging, like I think it's kind of a mistake to do a broad like black swan hedge or anything. Like if you want to be that trader that hedges or that investor that takes a smart view of the macro situation, there's not really a shortcut to that. You should either buy the index or start to learn about what specific risks you want to hedge against. Because if you try and hedge against them all, that's too much work and you're going to eat into your profits and you really might as well just buy the index.
So at the beginning of your statement there, you were brought up Amazon, and it triggered in my mind since we're about to talk about Black Friday, how they had the first ever Black Friday NFL game through Amazon Prime, and we've kind of been highlighting in recent streams the popularity of sports and how they just seem to be becoming more and more popular over time. And I was reading an article over the weekend how the most popular NFL game last year was the Thanksgiving game, and it got 44 million live viewers. So I don't know if the Prime game will get that many, but let's say they got tens of millions of viewers in Amazon on Black Friday. Do you think that would be massively beneficial for them?
Tens of millions of, yeah, I mean, I think that it's just like they do a great, like they do a great job, getting reminding you that they exist. Now, sometimes that's not always a good thing, but like, they're getting that constant like thing in your airwaves. And like I was even just like, oh, better check the Black Friday deals. I got some Black Friday stuff. Like, because there were good deals. And like, but it's just that like constant reminder that they exist that just like gets that into your flow. Had I not seen, like, I even saw that like Amazon Black Friday game, and I was like, oh, there's a game on today, fantasy, blah blah. And then that reminded me, I was like kind of busy with my family, but that reminded me to like get the deals. And I think they just do a really good job of just like, and football's just another way to just like get you into the app, thinking about the name, like, serving targeted ads to you, like we talk about, which is just like they do a really, really brilliant job behind that psychology. And it's like, I would say the vertical integration of media into product uh, is very, very interesting. The way that like Amazon is now like, and I think Apple to a certain extent too. Like, I don't really know what their plan is with the content, or they just have too much money and they just want like it's brand recognition ultimately. But it's a little more haphazard. I think Amazon, as we always talk about, they're very organized in how they approach these markets, and everything is like much more connected than I think I see from like Apple sometimes, especially. Google, I would say, is really like they don't do it as much as Apple, but Google takes some really weird shots where they're like not thinking, I think, enough about this organization. Um, but yes, I would say that uh, I would say that it's very interesting, all of this content stuff, the way it started to move into direct sales of like, we've seen it for a long time with like product integration on shows, where it's now like it's getting that much more heavy handed, where, a place like Amazon is making content just to get you there and control how they serve you the ads and your purchasing behavior. Um, it's Who knows where it goes next, but it is definitely a trend.
Yeah, it's so weird. It's like Apple, I think they just released a Napoleon movie, which is like the second biggest box office, like past Disney. So Apple is beating Disney in the box office, which is weird. One, and I guess it's just to create the biggest funnel possible for their products, right?
Yeah, yeah, I mean, I think it's all about like brand recognition, and that like and how that expands, like, but like I'm saying, like I don't know like what Apple in particular, other than just like broad brand recognition, I don't know how they think about that spending. Amazon, I get it so much more. I mean, maybe like maybe what Apple's thinking is like, oh, if we can get best picture, then that just like raises our overall like, profile as a company, where people think like, oh, Apple does even more. Um, but generally, like, I remember I was talking about this with like AMC when they brought this mining company, and everybody was like, "Oh, it's like a good investment. Like, they like it's a good time to mine." And I was like, "Yeah, but do you know how bad that says about their core business? That this is how they're spending money. Like, they can't actually think of ways how to grow their revenue to such an extent that they actually think it's a valid way to spend their limited money. This is heavily indebted to buy a gold mining company. Like, it might be a fine investment. They might make a 3x return on it or whatever. Even let's even say a 10x return on it. But that's not improving their business. Like, especially the kind of business that they have, if they don't figure out ways to generate more revenues and get more people to theaters, or profit more, they're dead in the water. And I think that that's like similar to Apple. It's just like, okay, like, um, your iPhone sales are shrinking. It's like, yeah, it might be nice if you win Best Picture, but like, is that a distraction? Like, ultimately, I would like you to sell more phones. Like, that's your core business. And figure out a way to sell more phones, sell more devices. You're a hardware company, and maybe that's part of the longer term play. But like, I don't know if it is. Like, because it's just like I can't imagine them being like, oh well, we'll only let you watch Apple streaming if you have like an Apple TV. Like, okay, maybe that's an eventual play, but they would have to be such a good streaming service, like far beyond where they are right now. Where I would be like, because right now, if they told me that, I'd be like, all right, I won't buy, like, I'll cancel my Apple subscription. I don't need to be like, I don't need to be ransomed for, like, a lot of times it's like a $200 device just to also pay you money to stream. Like, I'm not really sure how connected that is to their business, or how much they're just like a copycat, where they're just like, well, Amazon's doing it. We don't want to fall behind Amazon or the other like Magnificent Seven. So we might as well have a streaming service too. Where it's just like Amazon has a really good core business reason in my mind to have done streaming. And I don't get it for Apple.
The only thing that comes to mind for me with Apple is they're about to release that headset, or I don't know if they have yet, but it's coming soon if not. And maybe they want all their own content on there when that launches, or I don't know. That's the only thing that comes into my mind.
Yeah, but even they have talked about that as like a productivity app, a productivity device. They don't talk about it as like actually they make a distinction that Meta's is a entertainment device and theirs is a productivity device. So that doesn't really fit in with having a studio to me. The entertainment device fits more in with having a studio than that. So yeah, just like it isn't, it doesn't make sense. It isn't cohesive. And I think that when I look at, like, that is one thing that I look at, like, Amazon or even like Nvidia or Tesla, right? I look at those three companies and I'm always like, they have a cohesive plan and they're moving forward in a lot of directions. And I see these directions connecting well in the future, or continuing to connect. But I look at Apple, and it a lot of the time seems like they're running different businesses that I don't necessarily see that. Like, you did bring up a good point about like maybe how they think about it. But even then, I think that's a pretty massive investment versus like just creating video, like just creating like content that's for productivity around the headset specifically. It's a lot of money to start a studio just to maybe feed, your own unique content to it, which again, like, I think, I'm not sure any of the content that they're building right now is uniquely positioned for um for a 3D headset.
Yeah, and we got a question from Lazy Sundays about Apple entering the vehicle market, and what do you think that'll do for their business?
So, I mean, we've talked about the Apple Car a few times on the stream. And I think it could be really, really big for them. However, we've also talked about how they've messed up Apple Maps in the past. That was like one of their most spectacularly failed products. So I would be very interested to see how those, like, especially if they're going to make it self-driving, how far they've come in those guidance systems. I'm sure a long time, a lot of this is like, very incestuous in how these companies like hire, and a lot of it's kind of like open source in that sense, even if it's not open source officially. Um, but yeah, I think uh, here's what I think about it in terms of the actual product. I think that any Steve Jobs product, I was like, they're gonna nail. He knows how to do everything, and I've actually heard people make fun of Steve Jobs because, like, I think it was like a comedian being like, "Oh, I don't understand what he did. Like, he wasn't actually creating this. He wasn't the engineer." Blah blah blah. But anything he ran, Apple absolutely nailed, right down to like how it was launched and like the campaign behind it and the release and everything like that. Um, do I have as much confidence in Tim Cook Apple to do that? I don't really know. I think they've like lost momentum in it, like right down to like, I remember when the Apple iPhone releases were like a major event, and everybody's like, "Oh, what's the new feature going to be?" And I just don't necessarily see that being the case anymore. I don't see that kind of buzz. I don't see like all of the rumors around the new features. Like, all of that seems to like get less and less. Um, every year they release a new phone. So I do think that, it could be big for them. I don't like, where I lie on it is like, amongst any company, Apple's a bit like they haven't lost my faith in them to innovate on the whole. It could be huge for them, the car. Um, but I don't think they have my total trust that they're going to nail it anymore. And I think even the secrecy around it, and they're getting a lot of people to build this car. Um, even that, makes it very unknown how long it's going to take, how much money they're going to invest in it, and ultimately, you know, the amount of money that I know they're investing in it, what I've heard, like on the billions, but even that is like not very open in terms of how much and how clear it is. Um, they really have to nail it. And at the end of the day, I don't know if that's really their market. It might be too far away from their core product to a sense that, like, how good might they be at taking market share away from Tesla, just for one example? I don't know. And it might be a huge investment and not a big return for them. But at the same time, it could be like these are the types of things they need to be doing if they're going to get back to the kind of image that they had under Jobs. They could very well nail this. They've been working on it for a really long time. And obviously, if they do, they're right back in it as the best company in the world.
Yes, so thank you for your question, first of all. And I think I want to close the loop on this whole Black Friday discussion. Picking up where we left off on Wednesday, we were questioning on how good the sales would be and if people would spend on it with all of the things we're seeing in the economy. So we got some numbers. Spending on Black Friday was 9.8 billion, up 7.5% from last year, according to Adobe Analytics. 5.3 billion of it came from mobile devices, which was an interesting thing, over 50% of all the spending. They're expecting $12 billion to be spent today on Cyber Monday. So that's interesting. I think that Cyber Monday is now bigger than Black Friday. And what's the saying, George? Don't ever bet against the American consumer. It seems like that's living up to the theory.
Yeah. Well, I think what's very interesting about what we're seeing with this like big spending, um, in addition to like this debt just going up and delinquencies and defaults like going up and up, I think we're seeing like some general behavior out of individuals that we're seeing from the American government, which is just basically like, oh, like, we're really gonna have to pay the piper on this eventually, and maybe eventually like default on this stuff. We might as well just like spend as much as we can before that happens. I mean, that has to be to get like really no discernible reduction in spending as debt just goes up and up and up, like as we're basically seeing here. I think especially like that mobile behavior is very interesting, where we might be seeing more impulse purchases, where the kind of purchases where you like go at a computer, maybe sit down and understand your finances better, versus maybe a little drunk on Thanksgiving, like after Thanksgiving, or perhaps hungover. uh that could be a very different kind of spending habit. But yes, I mean, I think just even thinking about how people seem to approach these things, a lot of the times, if they're just like, okay, um, we're just screwed anyway. We're gonna have to default on these credit cards anyway. We're like behind. Might as well just spend it if we're gonna default anyway, and just like get whatever we can out of this before. And I think that is kind of the best explanation I see for all of the spending as the debts are climbing. Um, so yeah, I think what really remains to be seen is like just what we're talking about, just how much that's going to impact consumer spending, and just how much that actually like impacts companies outside of maybe a smaller world of you know consumer finance, consumer cyclical goods, like everyday purchases. Um, and maybe I would say the market is expecting that to be um, perhaps confined just to those areas. But I think the one other thing that needs to be said, and we talk about it all the time, is some of this is like how it's all ultimately priced in to these stocks. Like the way people are pricing this in, they could say, actually, we are expecting some pain to come in these businesses, but we're expecting that pain to come on like a economy that's like bottoming out and like about to be in the upswing with like inflation, getting right in line. And so we always talk about what's priced in, and that kind of like consumer spending difficulties could be priced in already to stocks in terms of how institutions are looking at maybe these stocks got a little too beat up in the bear market. Yeah, there's still some pain that's going to happen coming out, but we think ultimately that pain won't interfere with the price too much if like the overall tide of the economy is rising. Because basically a lot of these might be built into forecasts already, and people are just like, okay, I think that's appropriately priced in. And then all that might get priced in as like the upside when we're kind of on the other side of any difficulty coming. Because the reality is the defaults are already here. Um, and that those charge-offs are rising, and that's not to say we won't see any problems. I'm certainly not going to say that. But we might not see them that much in terms of how they impact stock prices in 2024. Or there's another scenario where we just really haven't seen it hit spending yet. And when it does actually hit spending, and when these defaults do actually, start to maybe get into even higher levels, that might start lowering company guidance. And then you might see a huge impact on prices. But even that might just be retained, like I'm saying, to consumer cyclical, consumer finance, maybe utilities, and then maybe some of these ad-driven businesses that are just going to expect less ad spending because there's less consumer spending.
Yeah, and the one follow-up question I wanted to ask you about this, because you see the sheer amount of money spent and the fact that over 50% of it came from mobile, is that do you expect like this trend that we're seeing where people just spend more and more on their phones versus in person to benefit e-commerce stocks like, PayPal, Square, all these ones that have kind of been hit and haven't rallied with the market as much this year, and even Shopify, all these companies that their main business is e-commerce.
Um, yeah. Well, I mean, I think that first of all, like, I wouldn't necessarily bet on anyone other than like Amazon and maybe Mercado Libre, like Alibaba, in terms of like these mobile shopping or anything shopping, everything store kind of places. Like, yeah, these things exist, but I don't know how long they exist. Um, as long as like these places are consolidating and they have more and more relationships, and like, I wouldn't bet, like, even if that's true, and it very well could be true that, say, Shopify, like, gets a big cut of how this stuff increases on an ongoing basis. But I wouldn't bet on that. I'd bet on Amazon if I wanted kind of exposure to this like mobile shopping situation. I mean, honestly, I do think ultimately it does just increase purchasing behavior. There's a lot of times where I'll just like impulse buy more myself. And I think a lot of people are like this, where you're just like, the transition from like, oh, I might need that to like it's in my cart and it's going to be here tomorrow is just like so quick. And like that being on your phone is very different than needing to go on a computer, I would think. So like I think it's definitely going to increase people's spending overall. I'd say has already, but like in terms of how that plays out to kind of like I would say not like the big three, and I would say like that's Amazon, Alibaba, Mercado Libre. That's like the Latin America and Amazon. Um, I wouldn't personally bet on that.
And we have another question from Lazy Sundays. Thank you. And this is actually a very interesting one. I think it'll enlighten a lot of people on like the inflation situation. She's saying that inflation has decreased, but products seem just as expensive. Why is this happening?
Mariah is asking a lot of good questions. She's actually training to help us uh, with some of our social media responses. Um, but I would say that that's actually a very important distinction. So when inflation is reported, that's actually the increase in inflation year over year. So we were, I think, down to like I think close to 4% in the last, Stephen, um, something like that, like getting closer to 4%. Um, but that 4% means prices, even at elevated levels last year, are still increasing 4% in a year. So inflation, basically the good way to understand that is the inflation increase is decreasing. And it was at like 8-10%. And it's nice that it's going, that inflation increase is going down, but that's very different than deflation, which is prices actually going down. Now, the thing that we've also observed in inflationary cycle, and especially the most recent ones, is that stores are like companies are being a little predatory, and they're increasing their prices beyond the rate of inflation. So both things that are true. That like yes, the rate of increase is decreasing, which means prices should still be increasing because we still are seeing even like a 4% increase year over year with this decreased rate of inflation. But we absolutely still are seeing prices increase beyond that increase. And that is just opportunistic businesses looking to profit off of the fact that people on the whole have gotten, accustomed to inflation. And companies, I think, rightly think that people are just more inclined to blame the government, um, their, person of choice of whoever they would blame in the government, than actually like point at corporations. So they're being very opportunistic with that. And yeah, I think like we live in a society of opportunity in terms of how much now companies or I'd say institutions will kind of push the envelope, take advantage of their customers or the people that donate or whatever, just because it's very easy to point the finger at whatever, government entity, blah, 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 that people already hate. And not look at, and that ends up, having people not change their spending habits with the companies because everybody kind of like blames inflation.
Yeah, I think that's a really good question. And spinning into our next story, which I think is really crazy. So, for the Chinese exchanges, they have a rule where shareholders who own over 5% in a company have to file to be able to sell shares in any company that they own. And the Beijing Stock Exchange, which has been up 42% in October, the past month, has been declining large shareholders from selling shares. So when these huge institutional like shareholders are trying to sell, they can't sell. And their reason for it was trying to boost the market even more and create a sustainable rally. I can't imagine if this was happening in America, what the response would be, or I don't know. It doesn't seem like a free market at all. It seems like something you'd see in crypto. But what do you make of this whole story?
Yeah, I mean, we talk about this all the time, and yeah, you're correct that we tend to talk about it more in response to the crypto markets. Um, but we talk about it more in like non-transparent, options bets, levered bets, which just makes it that much harder for people to understand like the market mechanisms or where they might be moving. But yeah, I mean, this is one of the reasons. Not only have we seen, especially with Alibaba, where we've taken on a few rides up, where we've definitely seen convincing option pricing behavior where people are making bets ahead of news stories. We've actually seen that a bunch of times. So we're already hip to this, like, oh, like China might not be as like as secretive in terms of like these things are more out in the open, these news stories before they happen, much more so than America, where it exists, but I would say not this bad. But also it's just like for me, how do I get excited about a Chinese stock with this kind of um news? Like, yeah, for sure. Like, I could make money because I know they're propping it up now. But the moment they decide to like let these people sell, right, that probably happens overnight in the Chinese market. By the time I wake up, the positions, all my gains could be gone because they've basically like finally said, uh, thanks. Like, thanks for all of this foreign investment. And, we're gonna let our big investors sell now. And then the prices tank. I think that's the problem with, market management is it ends up punishing everyday people that much more because obviously the people in the know are going to be the first ones with the opportunity to get out because they're essentially like, they're doing a favor to the government by like, not raising a stink or whatever, or, I don't know how much choice they really have. Um, but yeah, it makes it very dangerous. The further you are away from, say, like what the Chinese government ultimately decides and having like, your ear to the wind on that, like I'm sure some of these wealthy Chinese people do, for like being good sports about not being allowed to sell their shares, um, they're going to be the ones that get the first opportunity. And like for anyone that's like pissed about what Robinhood does, like which I am one of those people, like that is that on steroids, because not only are you getting that like, hey, certain people are that pay more are going to get to the front of the line, you are also getting a situation where like that front of the line might be a huge flood of shares when the government's like, okay, thank you for being patient with us. We're ready to like let the market take a little bit of a hit, and you guys are going to be the first ones to profit.
Yeah, it definitely doesn't seem right to me. Spinning into the next topic we have, Elliott Management, which is they take active positions in the companies that they hold. One they had last year was in PayPal. They've taken a new position in Crown Castle, which is a REIT stock. The position is worth $2 billion. And I wanted to ask you about if you could explain hostile takeovers to our viewers. I don't think we've covered it before, and what these, active investors do and how they can change a company and, all of that with these big positions.
Yeah, so my uncle's actually an activist investor, but um he does it mainly in the retail space. So I actually I've seen it happen. Well, actually, what I've heard happen is learning more about like actually the machinations between like the companies and even like activist investors. But there's certain levels, right? You first will take a big position, and sometimes you'll do it publicly, sometimes you'll do it privately. You'll basically say like, I don't think the company is operating as effectively as it can. Here's what I would suggest. And again, sometimes it's public, sometimes it's private. But likely, if it starts out private and you want a new CEO or you want, kind of new systems or them to move into a new market, it's lots of different things. But it's always like, I think you could be increasing your revenue and or your profitability if you do the following things. Or a lot of the times, it's like changing the CEO. And so first you might do this privately. Then if they don't listen, you kind of scale it up into uh, a public battle where you're just like, we're a large shareholder. This company is being mismanaged. They should share more about their shareholders. But eventually it can scale up into a hostile takeover. Now, a hostile takeover is essentially just uh, having a controlling interest of the equity. So, say at a shareholders meeting, you can pretty much vote and get whatever you want because that's what happens if you're a majority shareholder and you can vote on these issues and you can basically ensure that you win through your controlling stake. You know, whether that's changing the CEO or requesting the company, take certain other business actions. A lot of it, replace certain members of the board, like which obviously trickles down. Uh, all of this can be done if you're the controlling shareholder. Now, a lot of the times, if companies are smart, they can see that you're doing that, and they can buy shares too to make sure that you don't have a controlling interest. Or they might do business with hedge funds and say, okay, we'll actually like basically pay you a markup on the market price of your shares for you to sell us your shares. But people can do that on both sides, and it becomes a battle. So actually, like a company might not even try an activist campaign if they just don't expect the board and the CEO to work well with them. And that's why hostile takeovers can sometimes be very, very sudden because you might just very quietly start buying up a critical mass of shares that you'll need to basically show up at the shareholder meeting and start dictating exactly, basically start forcing the changes that you want through your controlling votes. But yes, even if you're trying to do it quietly, you never know. You approach a hedge fund, and they turn around, and basically, yeah, they'll turn around and be like, "Oh, we actually see what's happening. We're going to go to institutions. We're going to start buying shares." And you could end up spending a lot of money to not get your hostile takeover. It can be very, very difficult, depending on um, who the holders are, how much they typically hold, the churn rate, things like that, the supply of shares, and obviously the cost of liquidity to get to it. But yeah, these are pretty complicated situations, and a lot of the times it is pretty difficult to execute a hostile shareholder, especially if you're dealing with company owners with deep pockets. But like we're saying, sometimes what you end up getting is like companies that are not doing very well. So it actually becomes easier to buy the shares because there's lots of people looking to unload them because, you know, the company is viewed as not being managed well.
And Jonathan just shared a story of Carl Icahn doing this with Caesars, and then it was eventually bought by El Dorado. But maybe you could correct me or agree with me. I'm not sure, but typically it seems like when I've seen a news story like this happen in the past, it's initially bullish because essentially you have a big, smart institution saying there's more value in this stock than is being currently presented, and we think we can unlock it. So it seems like typically this is bullish, at least at first. Would you agree with that?
These things are so nuanced that I would disagree with that. So it's like, I'll give you an example specifically to this, right? You could actually know very well that the CEO is not going to step down. And basically you're buying a bunch of shares to tank the stock price, right? You could say like, I don't think it. I just think actually if I can complain and point out this guy's flaws and he's not going to step down, then I can buy Caesars at a discount because I know shareholders are not going to react well to me basically like airing how bad of a job they're doing. So there's lots of different ways to get to the end of this. And sometimes investors, activist investors, don't even like have a preferred outcome, right? They say, okay, either the CEO will step down or like the stock price is going to get trashed. They're going to look terrible, and I'll be able to do a hostile takeover. I'll just be buying up those shares as they come available, or some half measure where they're more willing to come to the table after they see that I might be able to get a hostile takeover, and they're saying, okay, like maybe the CEO will step down for a year, or we want to keep the CEO, but we'll trade some like board members and certain like SVPs. It starts to be like a negotiation that takes place. But I would say that like a cooperative activist campaign, absolutely. Like that is traditionally a very good sign for any company where, say Buffett takes interest. He's, the biggest activist. He's known as more of a value investor, but I would kind of consider him an activist investor too, where like, Buffett takes an interest. You're cooperating with Buffett. He's happy. He's buying more shares. That's pretty much always going to be a bullish sign. But I would say that is the big differentiator, whether the company is cooperative or not. If the company is cooperative, I would say it's almost always a bullish sign. If the company is non-cooperative, I would say it's almost always a bearish sign. Even if it's not bearish, like initially, an ongoing activist campaign against hostile large shareholders is never going to be good for the company. But like that cuts both ways, right? The activist that bought a bunch of shares, if the stock price is going down, that's not good for you as an activist investor either. You're trying to make your return, right? And if you're embroiled in this ongoing war that you're not going to win and the company's going to lock in, actually that can be real bad for your investment, maybe worse than the company, right? Because your job as a hedge fund is to make money, and especially as an activist investor, huge returns. So if you're 6 months, a year in, and you're just embroiled in this thing, and the stock price is going down, that could be bad for you, depending on your credibility with your investors. A lot, like if you have investors that trust you, they're looking at a 5-year time horizon, maybe even as much as that on an activist, where they're just like, okay, we knew this battle would take place, and we're going to see the return on the other side. But that is a really good kind of point in this whole thing, where it's just like it can be a real test of wills, and it can be the activist investor that's basically like, this is too long of a battle, and I don't want to keep doing this, and they'll pull out. Or it could be the company that eventually folds and gives in, or at least gives some concessions. But that is the game right there. It's like, okay, are the investors in the public company going to be more patient and loyal to the leadership, or are the activist investors like going to start to lose patience for the battle? So there's difficulties on both sides as this starts to happen.
And you brought up Buffett, and we got a question about how he didn't disclose his recent purchase. I'm not sure exactly which one it's
Yeah,
referring
recent
to.
purchase in what? I think we need a more specific answer, but we're happy to answer that with
Yeah,
more info.
if I can keep, I'll just keep going, and maybe they'll comment again. So, public service announcement: no stream Wednesday. We'll be back Monday. Only one stream this week. You can see all the best moments from today's stream across our socials: TikTok, Instagram, YouTube. So, they'll be out. Look out for those. We're gonna get into our last topic and this question. So, if you have any other questions, comment them now. I don't see a follow up, so I guess I'll start our last topic, and we'll see if we get it. Um, so Ulta Beauty reports this week, this Thursday. A stock you've liked recently has been Elf, so I thought it's kind of interesting that they're a very similar company, a lot bigger, I think. Although they've been down 12% this year to date, so they have not had success as the market's gone up. They've beaten estimates 4 quarters in a row. They have a forward PE of 16.3. The year-over-year profits are expected to decline 5.34 EPS to 4.96. So what do you make of Ulta Beauty? I know you like Elf. How does it relate to that company at all? And just your overall thoughts before they report, if any.
They profile pretty similarly, actually. Um, in terms of like where they are on the signals, I would say the main difference is like Elf actually is a 70 growth and a 54 profitability, and Ulta is a 90 profitability and a 41 growth. So I think that's actually what we see. We actually are seeing a little more bullish pricing in the long-term options markets for Elf than Ulta. But both are viewed as pretty positively in the signals, with upside breakout being about at least 20 points higher than downside breakout. So I think that, like, yeah, if you're looking for kind of retail consumer cyclical exposure that might outperform, that's, I think, as a good way. We talked about it last week. Even in a segment like consumer cyclical that we expect to not do very well, that also creates buying opportunities for, I'd say, especially why we prefer Elf, companies that are growing. Growing companies tend to be the best at outperforming, as long as they're profitable. Please keep that in mind. Just growth is not, but growth combined with profitability is very, very helpful in terms of how these companies are looked at. But yes, I would say absolutely. I would say absolutely that we're looking for that. We're looking for that kind of thing. Those are, in terms of consumer cyclical plays, both or either, um, a good way to get exposure to that industry and portfolio diversity, while perhaps avoiding some of the issues that are coming through with some other consumer cyclical stocks that we talked about. And I think you can tie that back to what we were talking about with like Amex and the credit defaults earlier, right? I do think spending that's related to higher end goods, like beauty products being a higher end good, um, are things that could weather the storm better and already are. So I think that that's like an important thing to look for, and maybe just a good little tip to add to the end of this. Like, ask yourself if something is a high end good that you're investing in, or is kind of like more exclusively a high end good. And that might be a good way to get exposure to the consumer cyclical uh, vertical without kind of some of the risks of the products being dropped. Um, because yes, traditionally, obviously, anything in consumer cyclical gets dropped in tough times. But I think that we're seeing for people that are like kind of on like the wealthier end, and Amex customers aren't necessarily like the 1%. We're talking about maybe even like upper middle class. That those people aren't necessarily showing signs of hurting. So those products are a good to look for.
It's funny that like you were highlighting growth and profitability, and it just pops into my mind like all roads lead back to the Magnificent Seven. That's why they've done so well this year. All so profitable, all growing, besides Apple, I guess. So I don't know. It just popped in my head when you were highlighting like, and these stocks have just been just on a tear this whole year.
Oh yeah, absolutely.
All right. Well, I don't.
Profitability growth. All
Yep.
right.
Don't see any questions. Sienna, sorry we couldn't answer your question. Maybe you'll be back next Monday if you're still watching. But that's going to do it for today. Have a
All
good
right.
day,
Thanks
George.
a lot, everyone.
See everybody next week.